Hello, everyone. Welcome to the Tax Bite podcast series. My name is Peter, and I'm very pleased today that I can introduce you a number of experts that will talk about the 2021 outlook. What will the new year bring? After a long year with a lot of challenges and a lot of tax developments as well, as you have been able to listen to in our podcast series, we look ahead at a new year with a lot of new upcoming developments and challenges. And I have with me today a group of experts who will share their view and their perspective on these developments. First of all, I have Ellen Kortvriend with me. Ellen is our Brussels-based head of e-invoicing and e-reporting center of excellence. We have furthermore Jean-Philippe van West. He is an EU tax law expert in our team. And we have Gilles Fransens, who is a transfer pricing expert but has a dedicated focus on the recent OECD and case law developments. So let's kick off because we have a lot of topics we want to talk about, I think, in this podcast. And first, I want to start with you, Jean-Philippe. So 2020 was, as I said, a very interesting year also for you. You finalized your PhD. It was published. Congratulations with that again. And now we are also looking ahead at some new interesting developments. From an EU law perspective, Jean-Philippe, what is coming towards us?
Well, thank you, Peter. 2021 will, according to me, a very important year for Europe. And I expect several new legislative initiatives and other important developments in the area of taxation. In particular, regarding the following four topics. First, we have taxing the digital economy. Second, further increased tax transparency. Third, fair taxation and tax competition. And last as well, there will be an increasing focus on green taxation. We will go through these topics in more details in a second, and we will address them based on the timeline in which they are becoming relevant over the course of the year. However, it is important to first have a look at the broader pictures against which these developments are taking place. And for the first time in history, a country left the EU, and Brexit is now a fact. In addition, Europe and the whole world are facing the current COVID crisis. And many political leaders in Europe, believing in the importance of the European Union, are of the opinion that now is the right time for a strong European reaction, with a focus on recovery of the COVID crisis, but as well a shift towards a more green and digital European economy. And let us start with the first point I mentioned, the recovery of the COVID crisis. In July 2020, the EU leaders have agreed on a 750 billion recovery plan that should partly be funded through new EU own resources. And this is something important because in the coming years, we will probably see for the first time real European taxes. And in addition, the European Commission published in July its 2020 action plan for fair and simple taxation supporting the recovery, containing, amongst other, 25 initiatives the European Commission will implement between now and 2024 to make taxation fairer, simpler, and more adapted to modern technologies. So this is some important background before we should jump into some of the details of the evolutions to be expected.
Yeah, and maybe to chip in here, Jean-Philippe, and it's Gilles here. Hello, everyone. If we are thinking about the COVID response, it's perhaps worth noting that just before the Christmas break, the OECD actually released some additional guidance on how the COVID situation should be looked at from a transfer pricing perspective. This additional guidance, which was released, focuses on four key areas. So that's comparability analysis, its losses and the allocation of COVID-19 related costs, its government assistance programs, and the last one is around APAs. Maybe touching on each of those areas very briefly here. If we're thinking about comparability, one of the key issues here is that there will be a delay between 2020 and also 2021 actually happening, and the financial data actually becoming available in the financial databases. And those financial databases are typically a key source of information to back up the economic analysis from a transfer pricing perspective. In 2020, for example, the financial databases, commercial databases, will not have data for 2020 itself because the year was still going on and the companies will not have closed their books yet. So the databases will only have data for 2018, 2019, where the effect of COVID will not be visible in the financials, of course. All of this means that companies will not be able to substantiate pricing using current data. And to address this, the OECD paper actually recommends looking at some other indicators, such as some microeconomic factors, basically the performance of the company during the COVID period, such as fluctuations in sales volumes, specific drivers of losses, and who controlled the risk linked to those losses, etc. But also some macroeconomic factors, such as a regression analysis on the relation between profitability of companies on the one hand and GDP fluctuations, so increases or decreases on the other hand. And this is an area where we've looked into quite a bit as well, and where you are actually able to see that correlation between the profitability of companies and GDP fluctuations. The second topic then covered in the paper around losses and COVID-19 related cost. The critical element here is the assumption of a risk. So just to give an example, if COVID-19 costs losses linked to customers not being able to pay the invoices, so effectively the company's credit risk, it will then be important to assess which party within the transaction or within the organizational structure actually bore this risk under the transfer pricing model. Is this, for example, the distributor, or is it rather the principal entity? And the costs linked to that risk would then also follow the same characterization. So the entity having the risk would also bear the cost. The third point then is around government assistance programs. And the question here is whether the benefits from the government assistance programs should be retained at the level of the local entity, which is initially receiving those benefits, or if these benefits may indirectly flow to, for example, a principal entity within the group structure. In general, though, the government's assistance programs would not really change the allocation of risk, but would rather have an impact on the ultimate financial consequences of those risks. So, for example, the example I gave for the COVID costs, say in the credit risk example, the credit risk would still be borne by the party which is ultimately, per the characterization, bearing that credit risk. But the ultimate financial hit might be mitigated or reduced to a degree thanks to certain government incentive programs, support programs rather. The fourth point then is around APAs, and there, in general, most APAs would typically remain in force unless COVID-19 or the effects of COVID-19 caused certain critical assumptions which were contained in the APA to be breached.
Thanks, Gilles. Indeed, I think that was one of the last major developments you touched on of last year, the COVID publication of the OECD. I think I want to chip in here because I think there was one a few days later, only a few days later, that is also very important, and is the trade agreement that was reached between the UK and the European Union. I think it was on Christmas evening that finally the green light came, that after lengthy negotiations and difficult negotiations, in the end, a trade agreement was reached. The document is more than 1,400 pages long, and I think it's a big relief for a lot of our clients or businesses that there is a deal. There was only one thing worse, I think, and that would be a no deal outcome. In this podcast, of course, we will not talk about the details of the trade agreement. It's more than 1,400 pages, as I mentioned. And there is a separate Brexit podcast series that you can listen to where you find all the details and where the trade agreement will be discussed in all detail, of course. But if you think about taxes and the outlook, what will it bring for taxes? I think that an interesting development took place end of last year, immediately following the trade deal, because the trade deal is not talking about direct taxes in general. And it's a very limited. There's one chapter, 3 articles or something. It's very limited. The trade deal talks about level playing field in taxation, no unfair competition. But the trade deal also is very clear that the UK is no longer to apply the European standards and the European framework. And they fall back on the OECD framework and the World Trade Organization principles, for instance, for fair competition. And we have seen already a very practical impact and consequence of that a few days after the trade agreement was signed. In Europe, and I hope you all know that, there is a framework for tax transparency called DAX 6, the mandatory disclosure rules. We issued a podcast on that in December, so you can find more details on this topic in that podcast. But interestingly enough, the UK has already abolished the European rules in its legislation. As a former member state, the UK had DAX 6 rules implemented in its national legislation, and already now these rules have been abolished and they fall back on the OECD transfer pricing rules. That means for DAX 6 that businesses will no longer be able to rely on any disclosures made in the UK, and then also in the UK the number of disclosures will be significantly reduced. For the insiders, the OECD framework basically only covers the hallmark D in DAX 6, which is one of the 5 hallmarks or categories of hallmarks only in the European framework. So I think that's interesting if you look forward, that we will see how this further will develop in the UK. How will the tax system develop? How will it differentiate from Europe? Because looking at Europe, Europe is going forward in the transparency agenda in 2021. After the DAX 6 rules that have now actually become live in January, we will look at further initiatives like DAX 7, the new update of the Directive Administrative Cooperation, the 7th step in that update, and that deals with cross-border tax audits and exchange of information. So we will see this will be a real game changer in 21 when this directive will be finalized, and that will really be about how tax authorities in Europe will be able to cooperate. So you clearly see that Europe is taking the step forward in tax transparency. You can also see that in the recent confirmation that Europe wants to go forward with public CBCR. The European Parliament has urged the Portugal presidency. The presidency of Portugal is now for the next month, so January to June, has urged Portugal to focus on public CBCR as a key element in to be looked into. So clearly Europe is taking the step forward with ultimately even a DAC 8 that will come, and that will deal with transparency on cryptocurrencies. So I think on this in this area, a lot of developments are to be expected in 21. I think, Ellen, I think also in your area, e-invoicing, e-reporting, we expect some very important updates here.
Absolutely, absolutely. Thank you, Peter. So I wanted to make the link from an indirect tax perspective as well to the transparency story that Peter just told us. And also making the link with what Jean-Philippe just referred to, that package for fair and simple taxation, because there's also an impact from an indirect tax perspective. So as Jean-Philippe mentioned, the package includes a number of initiatives the European Commission wants to see implemented between now and 2024. And one of those initiatives deals with the fact that the Commission wants to implement measures to help member states basically enforce existing tax rules and improve tax compliance. So from that perspective, the Commission is looking into publishing a proposal for modernizing VAT reporting obligations, which should ensure basically a quicker, potentially also real-time and more detailed exchange of information and in which they will also examine the need to further expand mandated electronic invoicing in that context. That Commission proposal has been fully confirmed by the European Council, and of course, it will have a huge impact on the indirect tax landscape going forward. We see that many changes that are expected for 2021 will also be driven by the VAT gap. The VAT gap is basically the difference between the expected VAT revenues in an EU member state and the revenue it has actually collected. You see that the VAT gap is often wrongly only linked to revenue losses due to things like tax fraud, tax evasion, but it's more than that. Also things like bankruptcies, administrative mistakes, or a malfunctioning tax collection system, can result into a revenue loss for member states. And the European Commission has mid last year published its VAT gap study, which is a study they are performing every year, which showed that the VAT gap for 2018 amounts to 140 billion, which meant at that time a marginal improvement of the VAT gap as compared to previous years. However, what we see is that the estimates for 2020 already show a reversal of that trend, with a potential loss of 164 billion in 2020 due to the effects of the coronavirus pandemic on the economy. And of course, with that in mind, it's not at all unlikely that further initiatives will be launched on member state by member state basis. So not waiting until the European Commission comes up with a new standard or with modernized compliance obligations, but really take an individual action to ensure a correct collection of VAT in their own member states. And that's indeed what we have seen happening a lot in Europe, but also beyond, where countries have massively, mostly, as I already referred to, a means to fight against tax fraud, but also to be able to perform more targeted audits, imposed requirements for what we call digital transactional reporting. And you see that where only a few years ago, there were only a small number of countries that had implemented such requirements. You can see that over a period of only a few years, the number of countries that have these types of requirements implemented has tripled over time. Those requirements, they vary from so-called on-request e-audit requirements, which means countries requiring, for instance, SAFTI files, standard audit files for tax, whereby you report your company's accounting information in a predefined structured format, making it possible for governments to conduct very targeted audits, data mining activities to those data sets. And this was, for instance, also one of the most concrete actions that Belgium has announced as part of the new government plan, the introduction or extension, I should call it, of the so-called BSAF, so the Belgian Standard Audit File for Tax. Secondly, it also covers so-called real-time reporting obligations, where you are required within a very short time frame after you have issued your invoice towards your customer to also report that transactional information or a subset thereof towards the authorities. And thirdly, it also includes countries having imposed e-invoicing mandates, meaning that you are no longer sending directly your invoice towards your buyer, but that you are first sending it towards the authorities for pre-clearance before you can actually transmit it towards your buyer, or a step further where it is also the government or the government platform who is responsible for the delivery of that invoice towards your buyer. Looking now at the roadmap of the already announced and to be implemented changes going forward in our surrounding countries, France and Poland are the most worthwhile mentioning, given that both countries have already indicated that they want to implement a full B2B invoicing mandate in 2 years' time. Of course, many other EU countries are also exploring which direction they will take. And of course, we will keep you posted on all those developments during our future update podcasts. To summarize, you see that the increased transparency from an indirect tax perspective, with more and more reporting on transactional level, more and more in real time, it really enforces companies to handle their compliance obligations and their underlying data in a different way. So you see that the accuracy of data in the system will be crucial. The reliability of your processes, being in control becomes, of course, more and more crucial in a world where, the manual correction of reporting is no longer a possibility. You see that drives, of course, companies more and more to look at their indirect tax, their direct tax control framework, which is one of the important trends I see as well for 2021.
Thanks, Helen. And indeed, I think that when you talk about indirect tax, I'm a direct tax person, but when I look at indirect tax, it links to the business and it very closely. And all these developments, what I hear from clients is that they are really afraid in a way that this will impact their day-to-day ability of doing business, of sending invoices and so on. So I think hugely important. And I also see it nicely fitting indeed with what Jill said. So coming back out of the Corona crisis, government budget will need money. The VAT gap is a way of doing that. So it nicely fits together, I think, in what 21 will bring for taxes. But Jean-Philippe, one of the policy objectives very clearly, I think, from the European debate was also the Green Deal, ecological taxes, and so on. What do you expect on that area, on that front in 2021?
Yeah, exactly. Yeah, Peter. So besides recovery from the pandemic, the realization of the Green Deal is a priority or one of the main priorities of the European Commission. And the Green Deal, one of the priorities of the Green Deal is being that there's no net emissions of greenhouse gases by 2050. And in a joint declaration by the Commission, the European Parliament, and the European Council in December, they said that implementing the Green Deal was a top priority. And although that maybe most of us might not be so familiar with green taxes, they will certainly become more important over the years. And it's worth highlighting some of the key evolutions that we will see in 2021. And first of all, the EU will introduce in 2021 a plastic contribution, which is a penalty on countries that do not recycle their plastic. Next, as well in 21, the EU is expected to come up with a proposal in the first half of 2021 with a proposal for a carbon border adjustment mechanism, for which there seems to be broad support amongst member states. And this new mechanism would place a carbon price on imports of certain goods from outside the European Union, and in order to push its EU partners to raise their climate ambitions. And third, the Commission is also expected to come up with a proposal in 2021 to extend its emission trading system, which puts a cap on the total amount of certain greenhouse gases that can be emitted by installations covered by the system. These three new type of taxes that I mentioned will form part of the new EU budget. And what is important is that, of course, these taxes might impact your business. It might influence your business model, and for example, as well, the pricing of the goods you're selling or producing. So these green taxes would be part of the new EU resources, but as well forming part of the new EU own resources would be a digital tax. But here, at the moment, the European Union is still looking at what is going on at the OECD.
Yeah, and maybe to chip in here, Jean-Philippe. So when it comes to the OECD process on the taxation of the digitalized economy, there hasn't been really significant developments in terms of new papers or positions being released compared to the blueprints which were released in October last year. The general public was actually allowed to provide input on those papers until the 14th of December last year. And there will be a public consultation on both Pillar 1 and Pillar 2 papers on the 14th and 15th of January. Ultimately, the goal is still to reach an agreement by mid-2021, so this year, the summer of this year, through the OECD process. On the other hand, though, many countries have already started acting unilaterally, for example, through digital service taxes, or declared that they would do so. And I think, well, Jean-Philippe, you will probably go into this in some more detail, but also the EU is expecting or is announcing to act on this front as well, absent an agreement at the OECD level. So all of this to say that something will be happening in 2021 on the taxation of the digitalized economy. The only question, though, and that's a question we will see evolving over the coming months, is whether an international agreement can be reached or whether individual countries or the EU, for example, will go at it alone. Maybe back to you on that one, Jean-Philippe.
Yes, thank you, Gilles. And indeed, the European Commission made clear that it will move forward alone if no agreement is reached at the level of the OECD. And especially with respect to Pillar 2, which is about the introduction of a minimum tax, there are rumors that the EU is really ready to come up with its own proposal if there is no agreement reached at the level of the OECD in June 2021. And speaking about Pillar 2 and its minimum tax, which would create a fair level playing field with competing with a minimum tax that you cannot go below this minimum tax. Fair taxation and fair competition is also a central point in the agenda of the Commission. And first of all, since the removal of the Cayman Islands in October from the EU blacklist, there is an increased support to change the procedure of how countries are blacklisted. And if they proceed with this change in procedures, it potentially much more countries might in the future appear on this blacklist. And furthermore, Europe is as well working on a harmonization of sanctions towards multinationals which have presence in a blacklisted country. And these sanctions could include, amongst others, the non-deductibility of costs, reinforced CFC rules, but as well withholding tax measures, so denial of withholding taxes, limitation of participation exemptions, and even the suspension of double tax-free provisions. These are just not concrete legislation yet, but these are ideas that are circulating. And we already see today that more and more member states take actions against multinationals with presence in blacklisted countries. And this is certainly something that will continue in the future and must be kept on the radar if you're a multinational. And a last point I want to touch upon is tax abuse, very briefly. As well, the European Commission made clear that this is something that remains high on the agenda. And well, we see already in our practice more and more tax disputes in all over the world, actually. Mainly in Europe as well, inspired by the Anti-Tax Avoidance Directive and as well the famous Danish beneficial ownership cases.
Yeah, and maybe to add to that, Jean-Philippe, there's been quite a bit of case law over the past years with a number of important cases also in 2020, and quite a few important ones also expected in this year. And what's interesting is that many of these cases are not necessarily limited to the legislation within a given country, but they actually give an indication of what the trends are where tax authorities are looking at, and how courts elsewhere in other countries may also look at to approach similar topics. So we've had the state aid cases with an important milestone through the Apple case recently, providing a stronger ground for the arm's length principle also through a state aid lens. And in some of the recent transfer pricing oriented cases, you can also start seeing an increased focus towards recharacterization of transactions, such as, for example, the recent Coca-Cola case in the US, where there might still be an appeal, of course. But this trend towards recharacterization and support of that by by the courts, of course, has significant consequences from a transfer pricing and operating model perspective. So it will be interesting to see how all of this plays out in the different territories, how this trend continues to evolve from a transfer pricing angle, but also how these Danish beneficial owner cases, which Jean-Philippe mentioned, which we've seen inspire tax audits across Europe already, how that will continue to play out and how that will be looked at in the courts in other countries.
Yeah, indeed. Wow, what a list of developments. I think this is the longest podcast we recorded so far in this podcast series, and yeah, with a reason, I would say. There's a lot coming towards us. These are challenging, but I could say interesting times as well from a tax perspective, to see whether tax will now be that problem that needs to be solved in the society, or whether tax can also be a solution to realize a stronger Europe, a stronger internal market, a Green Deal, and so on, and support the recovery from COVID. A lot is going on, a lot is happening. We will talk about these topics in more detail in our podcast series. So if you are interested in what we discussed today, I would say stay tuned, follow our podcast series and the Tax Bite podcast series. You can find them on the PwC website, but also on all the other platforms for podcasts. Stay tuned, because we will talk about these topics in more detail with the right experts along 21 when they occur and when something happens. So if you want to stay tuned, follow us. And I thank you for listening to this podcast and hope to hear you soon.